You are sitting at your kitchen table on a Tuesday night staring at an email from your conveyancer, and your stomach completely drops. You finally did it. You just sold that investment property you bought out in Logan, or maybe the western suburbs of Melbourne, 7 years ago. It is the exact same property you scraped together a $50,000 deposit for while eating baked beans and skipping family holidays. The settlement statement looks absolutely beautiful at first glance, showing a final sale price of $850,000. That means you made a cool $400,000 in gross profit. You are already picturing paying off your own primary mortgage, upgrading the family car, and finally getting ahead of the brutal cost of living in Australia right now. But then you scroll down to the bottom of the page and see the projected capital gains tax withholding, or you get the preliminary estimate from your accountant for your next tax return. The number is not $10,000. It is not even $20,000. The Australian Taxation Office is demanding close to $90,000 in tax payable immediately upon your next assessment. They are completely wiping out nearly a quarter of the wealth you just spent a decade slowly building. The truth is, you are not stupid for being caught off guard by this massive financial hit. You are simply running headfirst into an Australian financial system that is deliberately designed to obscure the true cost of building wealth until the exact moment you try to cash out. Every single weekend at a Bunnings sausage sizzle or a backyard barbecue, you hear your mates talking about property prices doubling and the massive benefits of negative gearing. But nobody ever talks about the brutal reality of the exit tax. The cost of living is suffocating ordinary Australians right now. From the grocery checkout at Woolworths to your monthly power bill, everything is more expensive, and property feels like the only reliable raft in an ocean of inflation. You were told your whole life that buying bricks and mortar was the absolute safest thing an Australian could do. You played by the rules. You took on the heavy debt, you dealt with the stressful midnight phone calls about broken hot water systems, and now that you are trying to realize the financial reward, the system is actively penalizing you for your own success. By the end of this video, you will understand the exact mathematical trap hidden inside the Australian capital gains tax framework that catches out first-time property sellers. More importantly, I am going to show you exactly how the marginal tax rate interaction works when you sell an asset, and I will give you 3 specific structural strategies you can use to legally protect your equity. You will know exactly how to calculate your true net profit before you ever sign a contract of sale with a real estate agent, ensuring you never hand over a single dollar more to the taxman than is legally required. The real force working against you here is not just the property market, it is the silent, progressive nature of the Australian income tax brackets colliding with decades of unadjusted inflation. Right now, in 2026, the Stage 3 tax cuts mean our highest marginal tax rate kicks in at $190,000. The government takes 45 cents, plus a 2% Medicare levy, out of every single dollar you earn above that line. But here is the secret that the government relies on to fill their coffers. They know that inflation naturally pushes nominal property prices higher over a 10-year holding period. You might have made a $400,000 gain on paper, but a massive portion of that is just the Reserve Bank of Australia devaluing our currency over the last decade. Yet, the Australian Taxation Office taxes you on that nominal gain as if it is pure purchasing power. They are effectively taxing you on inflation itself. They keep the tax brackets relatively static while property prices inflate, dragging hundreds of thousands of ordinary, hard-working Australian wage earners into the top tax bracket for one single, devastating financial year. Let us walk through exactly how this plays out in the real world, step by step, so you can see the trap before you step in it. Imagine you are earning $90,000 a year in your regular day job, taking home a decent but completely average Australian salary. You decide it is time to sell that investment property because interest rates are biting and you want to reduce your personal debt. You sell the property and make a gross capital gain of exactly $400,000. The first thing you remember reading online is that because you held the property for more than 12 months, you get the 50% capital gains tax discount. This is exactly where the false sense of security begins. You divide that $400,000 in half and think, fantastic, I only have to pay tax on $200,000. You mentally calculate your standard tax rate and assume you will lose maybe $40,000 or $50,000. It feels painful, but manageable, given the massive overall profit. You are feeling pretty good about your financial position at this stage. But here is the step that absolutely breaks people. That $200,000 taxable capital gain does not get taxed at a separate, flat property rate. It gets dumped directly on top of your $90,000 salary for that specific financial year. Suddenly, the Australian Taxation Office does not see you as an average worker earning $90,000. For this one single year, You are officially classified as a high-income earner with a taxable income of $290,000. You have just rocketed straight past the $135,000 threshold and blown right through the $190,000 top bracket threshold. Your regular salary already consumed the lower, cheaper tax brackets. This means almost the entirety of your capital gain is going to be taxed at the absolute maximum possible rate of 47%, including the Medicare levy. Even worse, because your income has temporarily crossed the $250,000 threshold, you trigger a hidden trap called Division 293 tax, meaning the tax office is going to hit your superannuation fund with an additional 15% surcharge. This is where the panic truly sets in for most sellers. Let us break down those specific numbers so you can see the reality of the damage. On your regular $90,000 salary, your standard tax bill is around $19,000. But with your new temporary income of $290,000, your total income tax bill for the year explodes to over $101,000. That means the tax directly attributed to the sale of your property is over $82,000. You take your $400,000 gross profit, subtract the $82,000 for the taxman, subtract the $20,000 in real estate agent commissions, subtract the marketing costs, and suddenly that life-changing windfall is shrinking incredibly fast. But before you get discouraged, I need you to pause and realize something important. If you are sitting there holding an investment property with hundreds of thousands of dollars in equity, you are already in the top 15% of Australians financially. You have done the hard work, you have built the asset base, and your situation is significantly better than it feels when you are staring at a massive projected tax bill. But here is the brutal, unspoken truth about the Australian property dream that almost no financial advisor will say out loud. The tax system is entirely designed to keep you holding debt and punish you for trying to eliminate it. The exact moment you sell an asset to pay off your own home and achieve actual independence, the government takes their biggest single cut of your wealth. It proves that the system only rewards those who continuously leverage and borrow, never those who simply want to be debt-free. If hearing that reality makes you realize why so many hardworking families are struggling to get ahead, drop a comment below so this message reaches the thousands of other Australians who are about to sell their properties completely blind. The reason so many brilliant, hardworking Australians fall into this exact trap is entirely driven by a behavioral blind spot we call the paper wealth illusion. When you check realestate.com.au on your phone and see your property estimate climbing month after month, your brain logs that entire figure as your personal wealth. You mentally spend that money. You mentally pay off your mortgage with it. You lock in the psychological reward of the gross number long before you have ever accounted for the transactional friction. When I sit down and run the numbers on Australian property portfolios, I have seen this happen constantly. People anchor their expectations to the absolute peak gross sale price, which triggers a massive emotional loss when the real net cash finally hits their bank account. The media makes this worse by only ever reporting on weekend auction clearance rates and record-breaking sale prices, completely ignoring the tax carnage that happens behind closed doors. It is a terrible feeling to realize you are the last person to get paid from your own investment, but understanding this psychological trap is your ultimate advantage. Once you divorce your emotions from the gross sale price and focus strictly on the net after-tax outcome, you immediately take back control of the transaction. Awareness of the trap is the exact first step out of it. There are 3 immediate, highly specific steps you can take this week to completely alter the trajectory of your property sale and legally shield your wealth from this massive tax spike. First, you must strategically time the exact date you sign the contract of sale. I do not mean the settlement date. I mean the date the contract is actually signed by both parties, because that is the exact date the Australian Taxation Office uses to record a capital gains event. Do not sign a contract of sale in May or June if you can possibly avoid it. If you sign in July, you push the entire tax liability into the completely new financial year. This gives you up to 15 months to hold the cash, earn interest on it in a high-yield savings account or your home offset account, and consult with professionals to mitigate the damage. Even better, if you know you or your partner are planning to take unpaid maternity leave, long service leave, or a career break, time the contract signing for that specific financial year when your base marginal income is at its absolute lowest. Second, you need to log into your MyGov account this week, navigate to the Australian Taxation Office portal, and look up your concessional superannuation contribution carry-forward balance. This is the single most powerful tax shield available to ordinary Australians right now. If you have not been maxing out your super contributions over the last 5 years, you have a rolling cap of unused concessional limits. In the exact same financial year that you trigger the massive capital gain, you can take a portion of your sale proceeds, and make a massive deductible contribution into your superannuation fund. You are essentially taking money that would have been taxed at 47% and converting it into retirement wealth that is taxed at just 15% upon entry. This strategy alone can save you tens of thousands of dollars, but it requires precise action before the 30th of June. Third, you need to aggressively locate and document every single capital expense you have ever poured into that property to increase your cost base. I am not just talking about the original purchase price or the stamp duty. If you installed a new color bond roof, if you paid for a major landscaping overhaul, or if you had legal fees during a boundary dispute, all of this increases your cost base and directly reduces your taxable profit. You should also contact a specialized firm like BMT Tax Depreciation before you sell to ensure your depreciation schedules were fully optimized over the life of the asset. Gather every single receipt from the last 7 years, hand them to a qualified accountant, and force them to scrutinize your cost base. Every single dollar you add to the cost base is 50 cents of pure taxable gain wiped completely off the table. True financial freedom in Australia, meaning having a fully paid off primary residence and a reliable passive income of at least $80,000 a year, is not about how much wealth you can build on paper, but how much of that wealth you can legally protect from the system when it is time to cash out. Understanding exactly how to protect your money from the tax office is just the first step. So in my next video, we are breaking down the exact mathematical strategy to use an offset account to legally skip your next decade of mortgage interest. Hit the subscribe button and tap the bell icon right now so you do not miss that strategy when it drops.